Negative 23,000. That's the massive miss we just witnessed in the July non-farm payrolls report. So why exactly did this terrible jobs data trigger a record high for the stock market?
Hello everyone, welcome back to AI Market News. Today we're breaking down this exact market paradox. We'll explore how weak jobs data can actually mean strong stocks, what it means for our investments, and how the Japanese markets and the USDJPY are reacting to these shockwaves. Section 1. The Friday Jobs Shock. Let's start with what happened on Friday. According to current market information, the picture is incredibly clear. The U.S. labor market is rapidly cooling off. The July non-farm payrolls report didn't just miss the consensus forecast, it literally came in at a negative 23,000. That's the first negative print we've seen since February. And the weakness goes much deeper than just July. Previous months were revised downward by over 100,000 jobs, leaving us with a stagnant 3-month average of just 20,000. Furthermore, the drop in the unemployment rate, down to 4.1%, was actually driven by labor force participation falling to a 5-year low. To top the whole thing off, wage growth slowed to 3.2% year over year.
For beginners looking at the mechanics of this, here's the underlying mechanism. When we see a cooling labor market, it means there's less pressure on the Federal Reserve to keep interest rates high to fight inflation. A lower rate hike probability makes borrowing cheaper for companies and reduces the appeal of holding cash, which ultimately leads to higher equity valuations and makes stocks much more attractive to buyers. And that dynamic is exactly what played out on Wall Street. As we can see in the chart, the S&P 500 S&P 500 rose 0.62% to close at a fresh all-time high of 7,757.64. The market completely absorbed the bad economic news because investors were driven by the expectation of fading Fed tightening.
The tech-heavy NASDAQ also rallied strongly, reflecting a 1.3% gain. It's absolutely fascinating to see how bad jobs data magically turned into tech market euphoria. Specific market movers really helped push this index higher. For instance, Palantir surged over 10% on strong Q2 results and a raised full-year outlook.
Section 2. Nikkei's massive Monday rebound. Now let's shift our focus to the Japanese domestic market. Fast forward to Monday, and those US Friday shockwaves created a massive risk-on rally for the Nikkei.
The graph shows an incredible 1,363-point surge, pushing the index up 2.08% to close at 66,970. What drove this action was broad risk-on sentiment and yen selling that pulled equity buyers right back into the market. This massive Monday rebound was heavily led by Recruit Holdings, which hit the daily limit up after raising its full-year net income forecast by 52% on the back of AI-driven revenue. We also saw strong leadership from semiconductor names like Advantest and Tokyo Electron.
Section 3. Central Bank Collision Course. Let's pivot over to the currency markets, where a major structural tension is building between the US and Japan, creating what looks like a real central bank collision course.
As we can see in the charts, immediately following the jobs report, the USDJPY initially plummeted, falling from 158.3 down to 156.68, while the dollar index hit a 7-week low. However, it fully recovered its post-payrolls decline by Monday afternoon, rising back above 158.40. The primary driver behind this volatility is the collision of two opposing forces, a dovish Federal Reserve leaning toward rate cuts, and a newly hawkish BOJ. Based on available data from the BOJ July meeting summary of opinions, the tone is notably hawkish. There were multiple calls from board members to accelerate the pace of rate hikes. One member stated the pace could be faster than markets currently expect, and one dissenting member even proposed raising rates directly to 1.25%, which is a stark contrast from the current 1.0%. For beginners, this simply means that while the US is looking to lower rates, Japan is signaling it will raise them. This narrowing interest rate gap creates a structural headwind, preventing the USDJPY from easily moving much higher.
Section 4. The upcoming CPI test. With much of the rate hike risk already priced out following Friday's jobs report, we all need to prepare for the next major market catalyst.
Looking at our economic calendar, we have a few key dates to keep our eyes on. On Tuesday, August 11th, we have the Reserve Bank of Australia rate decision and U.S. existing home sales at 10 a.m. ET. Also tomorrow, keep in mind that Tokyo markets will be closed for the Mountain Day holiday. But the absolute most critical event for all of us this week is the US CPI report, scheduled for Wednesday, August 12th at 8:30 a.m. ET. Market expectations suggest headline inflation may stay contained, but core inflation could remain sticky. We also have Tokyo options expiration coming up on Friday.
This brings us to a critical crossroad. If CPI surprises to the upside, rate hike expectations will snap right back, and the dollar could rally sharply. If it comes in soft, the case for a September hold strengthens. So the question we are left with is this: will inflation re-accelerate despite a cooling labor market? If it does, the Fed faces a genuine dilemma, and markets will have to reprice accordingly. Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.